Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got a special guest on the channel today, first time on the channel, Mr. Shane Obata, portfolio manager at Middlefield. Thanks so much for taking the time Shane, to come on the channel and talk about a particular ETF at Middlefield. Stock symbol is MINN, the Innovation ETF. So before we get into that, it's your first time on the channel. Typically when it's the first time on the channel, I like the audience to know who you are. So tell me very, very briefly, not your life story or anything, but what your experience is, what you do at Middlefield.
Okay, great. Yeah, thank you for having me and for putting me in front of your audience. Hopefully I don't
Pleasure.
dis So, yes, I've been in the industry for the better part of a decade now, and I've been a lead portfolio manager since 2019. So, really just I've been a finance nerd for a very long time, and so this is really kind of the ideal job for me. So, I'm very lucky to have the ability to have a job where I'm continuously learning and taking in new information and whatnot. So yeah, that's really the backdrop. And then specific to this fund that we're going to talk about, I've really developed over the years a deep interest and a specialization in US tech stocks in particular.
Okay, perfect. Thanks for sharing. So the
Yeah.
ETF in question, I just want to introduce it real quick and I'll share my screen because it actually made some headlines. If we're looking right now at the Morningstar, the best and worst performing Canadian ETFs February 2024. And if we look at the top 10 best performing ones, you see that MINN, the Middlefield Innovation Dividend ETF, which is the one we're focusing on today, is ranked number 7 as a top performing one. So that's actually really, really cool. So congratulations for that. So we're going to be focusing on this ETF today. This is the Middlefield Innovation Dividend ETF. Stock symbol is MINN, M-I-N-N. And I'm talking to my audience here, Shane, so just bear with me. Mostly when we're talking about Middlefield stuff, I always talk about the split funds, RS, ENS. But in case my audience doesn't know, you guys actually have 6 ETFs. And these have, correct me if I'm wrong here, I'll ask you about them later. There's no covered call on these, but I noticed that they have dividend in the name of all 6 of them. So it's very interesting because they are kind of dividend focused. And as you know, my channel is all about income. So it's definitely of interest. So let's talk about this ETF, Shane. So give me the overview, objectives, strategy. Tell me, what is this ETF all about?
Yeah, the innovation ETF, as you mentioned, it's a dividend fund. So the majority of the holdings are companies that already pay a dividend and that we think have the ability to continue growing their dividends over time. And
Okay.
then as you can imagine in technology, which is not historically hasn't been as yield friendly as some other sectors, we are also finding companies that we think have the financial capacity to initiate a dividend in the future.
Interesting.
So that's also part of the strategy, but primarily focused on dividend and have been growing the dividend. So the strategy itself, it's an innovation mandate. So I'm sure you've seen that term all over the place. That can mean a lot of different things. It
Yeah.
really is centered around technology and communication stocks. I think that's really where you see innovation. I mean, we can say technology is changing each and every sector nowadays, right? There's technology helping out in the financial sector. There's technology helping out in the energy sector, et cetera. But I think these technologies often come from within the tech sector and then permeate into other sectors. So it's a really exciting place to be, especially given the backdrop with AI this year and last year.
Yeah, for sure. And I just want to share my screen and show people what kind of stocks there are in here. So it
Yeah.
is an innovation fund. And there you are right there, by the way, portfolio manager. So just to give the audience, a quick, an idea, here are the top 10 stocks. So you have NVIDIA, Broadcom, Meta, AMD. So obviously, chip makers, technology, there's Amazon. But I also noticed it's not a pure play technology. There's L Lilly in here, which is pharmaceutical. And of course, there's other technology ones as well. So this is the top 10 here. And you also see the sector breakdown a little bit. Now, I did
Yeah.
go into the fund documents and actually pulled the list, although it's from September 2023.
Yep.
So you actually see the full list here. So it's not just pure play technology come, there's other things as well. So give me a sense of how do you, because this is an actively managed fund. This is it's not an index based. You're picking these companies. Tell me a little bit about the stock picking process. What do you look for when you pick these innovation companies?
Right. So I think, as you noted, it is diversified
Yeah.
beyond just technology and communications. Like I said, as you can see with the sector allocation, predominantly technology and communications, but we are finding interesting stories outside of technology too. And I think that our portfolio has a nice blend of concentration, which is to say high conviction, as you can see with some of our top 10 holdings here, but also enough diversification so that if something's working and something isn't working, it can help to mitigate downside risk, prevent drawdowns, if you know what I mean. So in terms of how we find our companies, I mean, many different ways, but I would say generally speaking, we're looking for the leading players in their respective industries. And I would compare that to, for example, a strategy that is looking for maybe the number two or the number three player that's trying to catch up to the number one player. We are okay paying a little bit of a premium if we think that a company has a technological competitive advantage. And I would say that in technology, it's definitely harder to catch up. If you're a very good company from the top, NVIDIA is a great example of this. They are executing so quickly and at such a regular cadence that if their competitors don't keep pace with them, they're going to get further left behind. So it's an interesting dynamic that I think it's tough to it's tough to catch up if the leading company is continuing to innovate over and over again. So that's part of how we find our companies. And then I would also say it's important to think about the structure of the industry as well. So for example, just because your cursor is near Alphabet there,
Yeah.
Alphabet, for example, it's in a tight market, right? It's controlled by a small number of players, kind of like an oligopoly type of online advertising space with Alphabet and Meta, and to a lesser extent, Amazon and other players, smaller players. But you can see how a concentrated industry such as that would have good pricing power, because if you want online ads, odds are you're going to have to go to these companies at the end of the day, right?
Yeah. Yeah.
Those are some kind of key drivers that help us to identify different names.
Very, very interesting. I just want to point out the phenomenal, I mean, innovation, anything innovation and technology related has exploded. And you see here since inception, you have, this is as of February 29th, very, very high total return, average annual of over 15%, which is really, really cool here. Very, very nice. So my channel is all about income investing. So talk to me a little bit about, all your ETFs, including this one has dividend inside the name. I checked the yield. It's about 2% more or less yield. But not all the stocks in there, like Nvidia and Amazon, there's no dividend. But is it because you feel like they might have a dividend, or it's not, it's a mix of dividend and non-dividend? Explain me that whole dynamic. Like you said before, that it's core dividend payers.
Right. I still think it's fair to say that we're focused on existing dividend payers, right? But the two that you mentioned, I mean, Nvidia has a very, very small dividend, but Amazon, for
Oh, okay, I
example,
didn't even know that. So,
no worries. It's almost nothing. So
okay.
it's but the point being, with a company like Nvidia, and even more so with Amazon, right? Amazon is just this behemoth company with a lot of great different businesses. And we think that the story for Amazon over a long period of time was really that it was unprofitable. They were continuing to grow and grow the top line, their revenue, but they couldn't make profits. And that's all changed recently. They're only now inflecting into profitability. And so we would say 2, 3, 4, 5 years down the line, it would not be surprising if this company is paying dividends and continuing to grow them. So
Okay.
that's how we look at a company like Amazon or even Google, for example. I would say that's at the top of our list for companies that will likely, especially following what Meta did, initiate a dividend.
Exactly. That's what I was going to ask. What I was going to mention. Meta just initiated a dividend, and I have also a strong suspicion maybe something like Google and Amazon might follow suit. So just to confirm, this is a pure growth ETF, meaning there's no covered. You're not doing any covered calls on any of these stocks, and there's no leverage used in this ETF. If you could just confirm that.
Definitely. So in terms of leverage, there's no leverage. In terms of covered calls, what I would say is some strategies will do covered calls systematically, which means kind of machine driven, right? You'll set some rules and then it will continuously write calls for you based on this rules-based system. But for us, we have the ability to do covered calls tactically, which just means when we think that opportunities are arising, when we think that volatility is high enough that we're getting
Mhm.
compensated enough for it. And maybe when we think a company that we like, for example, might have some near-term weakness, something like that. So we can do it more tactically, but it's not systematic, as in it's not continuously happening without us giving the stamp of approval.
Very interesting, very interesting. Interesting, but I mean, it's in terms of strategy. Writing cover calls, maximizing income. That's not the objective of the ETF. The ETF is really long. Is growth really, right?
That's right. That's right. I would consider it as a tool that we can use, but
Okay.
to your what you're alluding to is correct. At its core strategy, it's fundamental stock picking, trying to identify companies that we want to own for 5, 10 years, right?
Okay. Okay. And
Yeah.
if I would ask you for who is this ETF designed for, what would you say?
I think it's designed for people that want technology stocks and they want active management. And then there's other characteristics, like we definitely lean towards higher quality versus what we would consider junkier companies. So unprofitable companies, companies that are not yet developed, they don't pay dividends, they don't have good buyback programs. So those, especially in this interest rate environment, we think are a lot riskier. So for us, we think sticking with this high quality nature is really good. And then I would also say, with respect to active more broadly this year, last year was kind of a year where all boats were lifted, right? And this year, I think you're really seeing how an active manager such as myself can add value, in the sense of, even if we look at the M7, for example, right? The dispersion or the difference between the top and the bottom this year is tremendous, right? Like we have Nvidia, which is up over 80% this year, and then we have Tesla, which is down nearly 30%. So it's a rising tide is not lifting all boats like last year. I think this kind of environment requires some nuance, requires some deeper investigation into each of these names, and to have the ability to step into and away from certain stories and not just set it and forget it.
Interesting, interesting. Whenever I hear the portfolio manager say active management, I got to ask more questions along that because I'm just curious. So this is, I mean, you're picking the stocks. Do you have, are you constantly getting in and out of stocks? Will you trim some to take profits? Is that going on a weekly, monthly basis? Or is it more like, look, I have my core holdings and then maybe I'll add some. I'm just trying to figure out, like, month to month, how are you actually actively managing this fund in terms of stock selection, turnover rate, things like that?
No, it's a good question. And I would say, first and foremost, it's fully active. So if market conditions warrant being very active, as in doing things nearly every day, like that could happen, right? We go through these volatile periods such as COVID, et cetera, where it's you have to react, you have to protect capital, right? But generally speaking, in an ideal world where we're in a sustainable bull market, the economy is not too hot, it's not too cold, monetary and fiscal policy are not too loose or tight, that sort of backdrop, I think ideally we like to hold our core names pretty much indefinitely, right? Unless we see a change to the business case. So that's really the ideal situation. So you can see how ideally, even though we're active, we would prefer not to do as much, ironically. But and then in terms of kind of discipline around, you're talking about around your core positions, I think that's a really important thing to think of. I'm sure you actually do that with your own portfolio. And the idea is basically to have your core positions, but stocks that you expect that you can own for 5, 10 years. You really like the names, but if they get to a certain valuation where maybe you pare them back and you're just saying, okay, well, I still like this company, but at this valuation, I can redeploy that at something that's more attractive and probably has a better margin of safety, which is to say that it's trading closer to its kind of bottom floor value, meaning that it won't go down as much, right? When you're
Yeah.
riding something up that's done really well, of course, if that story changes, there could be significant downside. So I think it's important to trade what I would call trade around core positions.
Interesting, very interesting. So yeah, this is a very interesting ETF. There's a couple of things I like about it. I myself am a pure income investor. Cover calls, leverage. That's just me and my style. But I could see how this could be a really good ETF for more total return growth investors who want to get into the innovation space, which there's a lot of buzz, but want a little bit more defense, a little bit of that of dividend as well, and some active management. I think it's in my opinion, the way I see it, it's kind of like a defensive way to get this exciting innovation sector in one ETF, active management, great total return so far, obviously. So it could be very, very interesting. So, last question, and it's probably going to be the hardest one. A lot of these companies, or most of them, they're in a Nasdaq 100. Why should an investor choose this ETF over, let's just say, a Nasdaq 100 index ETF, which has, it's proven, it has lower fees, et cetera, et cetera? What would you say to that question?
I think some of the points that we touched on a little bit earlier in terms of taking advantage of what's happening in the markets this year, I think that's a good reason for owning active, right? Having the ability to make those decisions. Coming into this year, for example, thinking about, okay, well, I think the case this year for NVIDIA and Microsoft is a lot more straightforward than it is for something like Apple or Tesla. Like having the ability to do that, I think is worth something. So that's important. And then I would also say with the NASDAQ 100, if you look at the NASDAQ 100, I would think most people would be surprised at the sector composition. It's actually a lot more non-tech than people expect. So our fund will give you even more innovation than the NASDAQ 100. I think that's part of what we're trying to deliver. So for example, we're going to have a lot less exposure to consumer staples, which I think we can all agree is not the most exciting and innovative
No
sector.
innovation there, right?
So yeah, I think those are some key points. And then I wanted to make one more point on the dividend side. I know you and your clientele are very dividend focused. So I do think we're entering the golden age here for tech dividends, right? We've seen it with Meta and the reaction to the dividend initiation.
Very well.
And
The stock just went up after that announcement.
that's right. And I think previous to Meta, one of my concerns was that I felt tech investors would look at dividend initiations and dividend payouts as basically an admission that you can't innovate anymore, so you have to pay. This is specific to the tech sector, if you know what I mean, because older tech companies such as IBM, Intel, et cetera, that were known as dividend paying, they would have high payouts historically, and people often viewed that as they're lacking in innovation. But I think Meta and some of these other companies are showing us that we have the financial strength to continue innovating, and we're going to pay dividends to our shareholders, and we're going to have this financial discipline. So it's really promising for the tech dividend space. So I think it's a great time to start thinking more about it. We've seen Meta, we've seen Salesforce, we're expecting to see Google very soon. And I think the list is going to continue growing. So the opportunities are going to continue growing.
Yeah, for sure. And it's funny that we talk about dividends or dividends coming to these big tech companies. We felt the same way. My wife and I were actually talking about it over dinner one time, and we estimated, look, are they really like super hyper growth companies anymore? They're starting, especially the big guys. They're more very established profit machines. It's only normal they'll start initiating dividends, and like just a few weeks later, Facebook announced their first dividend. So I honestly think you're right. I think especially like Google, Amazon, even the chip makers. I mean, these are profit machines. Dividends are profits. Why not give some out if,
Yeah.
let's say, the innovation is starting to die down? But they're still innovating, of course. They're still going to continue to innovate. So, Shane, thanks so much for your time. This was very, very interesting, and I recommend my viewers to check out Middlefield's lineup of ETFs. MINN is just one out of the six. There's other ETFs as well. And we'll probably be talking about the healthcare one soon as well, because you've been active on that one as well. And another thing is that Middlefield has a YouTube channel, and 6 days ago, you did a whole webcast or a podcast on MINN ETF. So I strongly suggest for you guys to watch it. If you're interested, I'll put all the links in the video description below, so you guys could check out MINN for yourselves and do further research on it. Very interesting for growth investors who kind of like dividends, want a little bit of defense. I think it's a very interesting concept. A lot of my viewers are not pure income investors. They want a little bit of growth. So this is maybe a really good option, especially if they like technology. So Shane, thanks so much for doing this. It was nice having you in the channel. Hopefully you come back again, and take care, my friend. Good luck.
Yeah, thanks for having me.
All right. See you next time. Take care.